John owns a few rental properties. They net him $50,000 per year in profit. He thinks he has to pay income taxes on all of it, but he's wrong. Because there's a little known deduction that can knock 20% off that number, saving him thousands. It's called the Qualified Business Income Deduction, or QBI. And if you own rental properties or plan to, it's something you definitely need to understand. Let's break down how it works, who qualifies, and what you can do to make sure your rental income gets this powerful deduction. Let's start with the basics. The QBI deduction was created as part of the 2017 Tax Cuts and Jobs Act. If you qualify, it lets you deduct up to 20% of your net rental income before calculating your income taxes. So if your rental property earns you $30,000 after expenses, this deduction could knock that down to $24,000 for tax purposes. That's a $6,000 deduction just for doing it right. But here's the catch. Not all rental property income qualifies. To claim the QBI deduction, your rental activity has to be considered a trade or business, and the IRS gives you two different ways to prove that. Option 1 is using the safe harbor rule. Option 2 is qualifying under the general trade or business test, which is sometimes called the Section 162 test. Let's take a look at both. The safe harbor is like a shortcut. If you meet its requirements, the IRS will automatically treat your rental activity as a business. To qualify under the safe harbor, you need to keep separate books and records for your rental. You need to spend at least 250 hours per year doing rental services like maintenance, showings, lease renewals, bookkeeping, and so on. You also need to keep detailed time logs showing what you did and when. And finally, you have to file a signed statement with your tax return saying you're using the safe harbor. Let's say Sarah owns a 4-unit rental property. She screens tenants, handles all lease signings, coordinates repairs, and does her own bookkeeping. She easily puts in over 300 hours per year. She keeps records and files the safe harbor statement. Sarah qualifies. Her rental income is eligible for the QBI deduction. Now contrast that with Mark. Mark owns a single-family home. He signs a lease with a tenant and doesn't touch the property for the rest of the year. A property manager handles everything else. Mark doesn't track any hours, no books, no records. Mark doesn't qualify under the safe harbor. Now, what if you don't meet all of the safe harbor requirements, but you're still pretty involved? The IRS has another option, the Section 162 trade or business test. It's not as black and white as the safe harbor rule. This one is all about facts and circumstances. So you need to ask yourself, are you doing this regularly and continuously? Is your rental activity actively managed and not just a passive investment? Do you actually work on the property or manage contractors? Here's an example. Carlos owns 3 duplexes. He doesn't hit the 250 hours per year, but he does annual inspections, responds to tenant issues, personally handles turnovers, keeps books, and hires contractors. Even though he doesn't meet the safe harbor requirements, Carlos is clearly running this like a business. He likely qualifies under Section 162. Now let's look at Julie. Julie has a triple net lease property. This means that the tenant handles all repairs, taxes, and maintenance. She gets a check each month and doesn't do anything else. Julie has a great investment, but she doesn't have a business, and she probably isn't eligible for a QBI deduction. I think you get the point. Now, what other things should you know about this deduction? First, ownership type doesn't matter. You can qualify for QBI whether you own your rental property as a sole proprietor, use an LLC, file through a partnership, or even as an S-corp. The deduction flows through to your personal tax return. Second, income limits. High-income earners may face limitations or phase-outs, especially if your total taxable income is over $191,951 if you're single, or $383,901 if you're married filing jointly. These numbers are for the 2025 tax year and adjust annually. But even if you're above those thresholds, you might still qualify. It just gets more complicated. Definitely talk to a CPA if you're in that zone. So what can you do to boost your chances of qualifying? First, track your time. Use a spreadsheet or app to log the hours you spend managing or working on the property. Second, keep separate records. Maintain clean books just for the rental. Having a separate bank account also helps. Third, don't be too hands-off. If you outsource everything, the IRS may not see it as a business. Fourth, file the safe harbor statement. If you meet the requirements, this is the easiest way to lock it in. And fifth, work with a pro. A good CPA who understands rental real estate can save you from missing out. Bottom line, the QBI deduction is one of the most powerful tax tools available to rental property owners. But you have to be intentional and diligent. If you treat your rental like a business and document your work, the IRS might just reward you for doing so. And that could mean thousands of extra dollars in your pocket every single year. And if you want more practical tax tips and rental real estate hacks, make sure you like and subscribe. And I'll see you in the next one.